I built an algorithm to test one of the most popular ICT concepts, the ordered block. I tested it the way the hedge funds do, over 10 years of market data. Today, I'll show you exactly how it performed and how it compares to a fair value gap strategy over the same decade. Just real execution, real costs, real numbers. Because in trading, only one thing matters: data. And if the data doesn't confirm an edge, it doesn't exist. Let's take a look at bullish example. Bearish example would be exactly the same, just reversed. We need a down close candle. Next candle needs to close above the previous down close candle. And then, within the next 5 candles, it needs to touch the order block. So here is the limit entry. Stop loss at the order block low. It will target 3-to-1 risk to reward ratio. That's the whole strategy. In last 10 years, it made around 25,000 trades. This is really good sample size. With 3R, it got 24.9% win rate. For break-even, it would need 25% if we don't calculate any fees or slippage. So this strategy isn't profitable. The total profit and loss is negative $252,000 and the maximum drawdown is negative $263,000. From all strategies that I shared here, this is the worst performing one, and Sharpe ratio is negative 2.4. The maximum consecutive wins it got is 7 and the maximum consecutive losses is 29. Even if we wouldn't calculate fees or slippage, it would still underperform. I ran a full optimization cycle on this strategy. I tested taking TP at 4R, at 2R, 1R, and the best performing one was take profit at 1R, which needs win rate to be above 50% to break even. Win rate is 50.12%. So not even 1R is profitable. What the testing revealed is interesting. There are only 2 time windows where the 3R order block model shows statistical profitability, from 9 AM to 10 AM and from 1 PM to 2 PM. Outside of those 2 windows, the edge disappears. No expansion, no statistical advantage, just noise. Here you can see at 9 AM to 10 AM time, it made around 1,600 trades, and overall, including fees, it made $46,000 profit. And the second most profitable time was 1 PM, where it made almost $35,000 with about 1,400 trades. But outside of these 2 hours, it mostly doesn't have any edge. Let me be clear. This simple order block model doesn't make money. Now, compare it to the fair value gap strategy from the previous video. Order blocks, negative $117,000. Fair value gaps, positive $150,000. If someone is selling your high win rate order block system, be skeptical. In its basic form, it has no edge. And in professional strategy development, if the foundation isn't profitable, it gets thrown in the trash. Every institutional grade model I've built that has strong Kalmar ratio, strong Sharpe ratio, started with real, measurable edge. If you're trading ICT concepts and care about results, focus on strategies that actually survive data. Because at the professional level, strategies aren't judged by how they look, they're judged by how they compound. And if it doesn't compound, it doesn't belong in your portfolio. What you're looking on the right is one of my higher performing internal systems, the Juggernaut strategy. I've developed several high alpha systems that significantly outperform the S&P 500 with strong risk-adjusted returns. They didn't come from patterns on a chart. They came from quantitative research, deep testing, and disciplined validation. If you're serious about trading and want your strategy tested at a professional standard, with full performance metrics, drawdown analysis, and regime breakdown, I'll be opening a limited number of testing slots over the next month. Because confidence in trading doesn't come from belief, it comes from data.